All right, so again, welcome to How to Reduce Your Debt. Again, my name is John Hamby. I do work for Members Credit Union, and we are excited that you are with us today. We are going to talk about a couple of things today. We're going to start off today with talking about some myths in the credit world. Many people tend to listen to myths rather than seek out the advice of the experts because sometimes it can be embarrassing when we don't know exactly what to ask. We find ourselves in situations sometimes that we don't know what to ask or who to ask. So I want to just start this morning by talking about some myths. These are the top 5 myths and misconceptions that a lot of people have when it comes to their credit. The first myth is that you only have one credit score. Um, the truth is you can have a wide variety of different scores, not just one, um, or even up to 3 with the 3 credit bureaus. There's a lot of different factors that go into that. There are 3 main national credit bureaus, that is Equifax, TransUnion, and Experian. Those are the 3, and generally speaking, they're usually um, regional. So you can, depending on what type of or where at in the United States that you live in, those are it kind of depends on who pulls from different ones. But creditors can report to all 3 of them, or they can choose to only report to 1 or 2 of them. It's up to which creditor that you have. The second factor is there are dozens of scoring models that can be used to calculate your score. When you look and think about what all goes into creating your particular credit score, there's a lot of things that go into the variables. And we don't have the time today to go into those, but I mean it's everything from how you pay your bills, when do you pay them, how much is your balance on credit cards, what different types of credit that you have, credit cards, mortgage, car loans. There's a lot of different things, and every one of the models that goes into that scores your score a little different. So when you do look at those 3 main credit bureaus, if you pulled your score for each one of those, you're going to see that they're probably going to differ and sometimes differ quite a bit. And the credit scores, the third thing, credit scores do change constantly. Um, each month, creditors report to the credit bureaus, and they go through this whole model process again. And so your score can change at any time from day to day because all creditors are reporting at different times throughout the month. The second myth is your score will drop if you check your own credit. This, of course, is a myth. You don't have to be afraid of checking your own score or report. There's a difference between a hard inquiry, which can be made when you apply for credit, that can bring your score down, but checking your own score is usually a soft inquiry, which doesn't harm your credit. You can also go to annualcreditreport.com. There at annualcreditreport.com, you can pull all 3 of your credit reports once a year. It does not give you your score, but it does give you the content of your of what is on your credit report, and that's a good idea to pull that at least once a year for verification, because you want to make sure that you do have the correct information, and if something is on there that shouldn't be on there, then you have the opportunity to contact those credit bureaus and file a dispute. The third myth is closing old accounts is always a good idea. A lot of times when we are looking at how to reduce our debt and getting rid of it, we pay something off, and the first thing we want to do is close that account because, well, obviously we're not going to use it anymore. And that's not always the case. Canceling old credit accounts, and when I mean old, I'm saying accounts that you've had open for an extended period of time. So when you've got an older line of credit or an older credit account that you've had for a while, if you close that, it could lower your score because one of those factors in your credit score that we were talking about a few minutes ago is the length of your credit history. When you close that credit account, they can no longer use that credit account for the length. It's now closed, so there's no activity to it. So you lose your utilization rate in that. If it is one of your oldest accounts, you could lower your average age of accounts and damage your score when it falls off of your report. So what I like to tell people is, if you're looking at paying off credit cards, um, if there's one or two that maybe you have opened here recently, think about closing those if you really do want to close something. But definitely keep your longer standing ones, because that actually does help your credit score. And if you're tempted to possibly use that credit card, then cut that card up, get rid of it, shred it, and then if there is an emergency that you do have to come up with those funds and you do have to use those immediately, um, it's as simple as calling the credit card company and saying, hey, I need a new card sent to me. Within a couple of days, you're going to get a new card, be able to take care of what you need to in that emergency. But it's not in your wallet, and you can't, go to the mall and decide that you want to spend some money. So that's what I advise people rather than closing accounts. The fourth myth is being a cosigner doesn't make you responsible for an account. Of course, most of us realize that this is a myth, that when you open a joint account or you cosign a loan, you are taking that legal responsibility for that account. Any activity that's on that account, whether it's good or bad, is going to show up on both persons' credit reports. So if you do co-sign for, a family or a friend or someone that you do realize that if they default on this, that it is going to not only count against you, but it also does make you liable for those future payments. But on the flip side to that, if they do well on that account and they take care of what they need to, then it can also be a positive and boost your credit as well, because you're getting that good payment history on there. So it has its good or bad. I think you just need to be aware of the responsibilities that come with being a cosigner on someone's account. And finally, the fifth myth that a lot of people think is that your credit report is always accurate. 2013, the Federal Trade Commission found that 1 in 4 consumers identified errors on their credit reports that might affect their credit scores. So again, here's that website, annualcreditreport.com, that you can check for inaccuracies. I just went through this probably about 6 or 8 months ago. I actually got a bill in the mail from a credit card catalog company that has their own credit, kind of like a finger hut kind of thing, and found out that someone had ordered a refrigerator or opened an account in my name, my social security number, and ordered a refrigerator that was supposed to be sent to my house according to this, but it was a scam, and they had actually intercepted it in shipping and was actually on its way to Africa. So I had to call them and get that taken care of. I had to call the credit bureaus, and I had to get that disputed and taken care of, as well as putting a block on my credit report so that no one else could pull my credit report without my knowledge. So there are inaccuracies out there, and if you do need to, report those types of things, most of the credit bureaus are very easy to work with, and you're able to get those disputed and handled rather quickly, I believe, in my experience. So diving into our specific topic of the day, how can I reduce my debt? So we're going to look at a pattern here over the next couple of slides that's going to give us a formula to be able to reduce our debt using the money that we currently have, and then finding ways of maybe putting just a little bit extra to that, and it's going to create a snowball or a domino effect. 78% of Americans live paycheck to paycheck. And this is, of course, by a survey done in 2017. And then the Federal Reserve Report on Economic Well-Being in 2016 shows that 44% of adults can't cover a $400 emergency. And so our goal, of course, is, the more debt that we can pay down, the more we can put back into a fund and have an emergency fund put back. A good emergency fund is to have um, a month's worth of bills, living expenses, and other bills put back into savings so that if something did happen, that you have at least 1 month that you know that you can get by. Um, some financial advisors advise a lot more than that. Ultimately, that would be the goal. Sometimes it is daunting, and we get a little fearful sometimes when we think about having that much in savings. And especially if we're part of the 78% of Americans living paycheck to paycheck, how do we get that emergency fund put back? And the answer to that is, reducing our debt, paying attention to how much debt that we do have, so that we're not paying unnecessary funds into bills that we have collected because of choices that we have all made. So our first step into this pattern that we're going to talk about today is, the first thing we want to do is we want to gather up all of our debt, except for your mortgage. So this is going to include doctor bills, car payments, credit card payments, school loans, anything that you have that you are paying a monthly payment on, with the exception of your mortgage. You want to gather all of that together. And I found that this statistic was pretty amazing to me, that came out in 2018, that the total American household debt is over $13 trillion. And that is just amazing to me, that we have that much debt in our homes that we deal with. So step one, gather all of our debts. The next thing we want to do once we have gathered all of those together is we want to make a list of those from our smallest to our largest. So whatever the smallest balance is, we want to put that as number one, and then our next smallest balance is number two, all the way up to our largest balance. And again, don't worry about adding your house in, just worry about your medical, your credit cards, your car payments, your students. And don't lump all of your credit cards into one large batch. Separate those out as individuals. So, if you've got a Discover card, that's one. If you've got a Capital One card, that's two. If you've got, any other kind of credit cards that are out there, then, that's going to be 3, 4, 5. And take care of those, the balance, starting with the balance. We're not really concerned with what the interest rate is on each one of those. It's more of what the balance is, and you'll understand that here in just a moment while we're looking at the balance. So the third step is to continue to making the minimum payments on all of the debt except for the smallest one. Now this is where we start to get into our formula of how we're going to get this accomplished. So on every single debt except for our smallest, we want to make whatever they're asking us is the minimum payment. Okay, that is very key, and then we're going to talk about that minimum, that smallest one, in just a second. But we want to continue to make those minimum payments on everything that we can, and then we want to try to pick up that extra side job by either having the side money, by either having a side job or a yard sale, or maybe it's tightening up your budget somewhere that you identify that maybe you're spending a little extra, and maybe tighten up on that a little bit, because the key here is that every small amount that you can gather in a month's time is going to help you. And you think, well, John, how can $5 or $6 a month help in the grand scheme of things? Well, over time, it will. It will. And so I'm going to go back to step 3 here after making comment on step 4. On this smallest payment, you are going to take whatever that minimum is, and then you're going to take whatever the extra that you come up with in a month, and you're going to add that to that smallest payment. Okay, So in step 5, we put all of that extra cash towards the smallest debt, okay? So in our example here that we see, our first debt was a medical bill. And so the goal here is to take everything that we can get in extra, extra the money that we made from the yard sale, or we helped a neighbor, put up a fence and they gave us an extra $50 for helping out. Whatever the case may be, however we come up with that extra, we decide this month we're going to skip Starbucks runs in the morning and we'll eat, we'll eat something, from home, or either make coffee at home or grab the coffee out of the coffee machine at work that is 25 cents versus $3. All of that money we put towards, and we really go into this first debt, and we attack that thing the best way that we can, and we get that debt paid off as quickly as we possibly can. And then it's a domino effect from there. So when the smallest debt is gone, we roll that payment over to the next one. So we take what we were paying, for instance, let's say that medical bill that we had, our first debt, the medical payment, let's say was $25 a month. And we were able to cut something out and add an extra $10 a month to that. So we're paying $35 a month to the first debt. We're paying the minimums on everything else. And now we've got that first debt paid off. So now we have this $35 sitting here that we were using for the first debt. And now we're going to add that $35 to whatever our car loan is, our debt number 2 here we see. Let's just say our car loan debt here was $150 a month. So now we've got $35 that we're not using anymore for debt 1. We're going to add that to what we're already paying on car loan, which is debt number 2. And now instead of paying $150 a month, we're now paying $185 a month. And we continue that until that next highest payment is taken care of. And now what we'll do is we'll repeat this until we are completely debt free. So once number 2, the second debt is taken care of, we have $185 that we're paying for the car loan. Now we have our next debt, and we're going to take that $185 and add it to the minimum that we're paying on debt 3, and we're going to put all of that in there. And then, so as you can see, what this does is a couple of things. Number 1, it breaks down your debt into manageable opportunities for you to succeed. One of the biggest things in anything that we do in life, whether it is finances, whether it is losing weight, getting on an exercise, going to the gym, when we don't see results, we start to lose our drive, and we get frustrated, and we want to just give up, lay back, quit, because we're not seeing the results that we're hoping to. More and more, especially in our younger generation, we are a very instant gratification type of society. And we want to see things happen now, and we want to see things happen quickly. And when we look at working on something and we say, okay, this is going to take 2 years, by the time we get about 6 months in, unless you're just a very dedicated person, a lot of times we lose that focus, we lose that drive, we lose the willingness to continue on. So by breaking it down in this manner, what happens is you'll find yourself making these small goals more frequently. So we're not using any extra money than what we already are using in our monthly budget, but we're knocking this stuff out. Now, some may take longer than others. When we get past our smaller debts and our credit cards, and we get up to looking at our car loans that can be 5, 10, 15, 20, or even more, in thousands of dollars, obviously that's not something that's going to happen, super quick. But by the time we get there, along the way, we have already seen ourselves pay off this credit card, and then we've paid off this credit card, and we've paid off this medical bill, we've paid off this debt, and now we're truly working on the credit on the car loan or something that's a larger scale. But we know that we can do it because we've already proven to ourselves through the last couple of months and the times that we have been able to accomplish these small goals. And by accomplishing those small goals, we keep ourselves on track. So we start off with our smallest. We make the minimum on everything except that one. We try to throw everything we can at it. And then we snowball that into the next one, which continues on until we are completely debt free. I have used this myself in the past, and I know that for me it worked. Sometimes it was tough. Sometimes I had to make the decision that coworkers are going out after work, or my friends call me on a Friday or Saturday night and want to go out to a dinner, and it was the hard choice sometimes that I had to say no, that I can't go, not because I told them that I didn't have the money, but it was because I just, if something's come up, I'm not going to be able to make it. But I was able to focus myself on the bigger fact that I was tired of living paycheck to paycheck, and I had to put myself in a situation where I could get myself out of the debt that I had created for myself. Ultimately, for me, trying to live up to what my other friends had, living, trying to keep up with the Joneses, if you will. And so, I had to make those hard decisions. So there may be some hard decisions sometimes that you have to make, but in the ultimate, it's going to be a great time when you are to this point of being debt free, and you'll be able to not be a part of that 78% living paycheck to paycheck. All right, so I am going to stop the recording now and be able to chit chat if you would like, either audibly or with the chat box.